Welcome everyone. Welcome to this episode of Market Trap. I have with me Mr. Pankaj Pandey. And this week, while nothing much happened over the week, I think once again, last time also I introduced with this line that while nothing much happened, today was something interesting. And once again, this Friday we saw some tumble in the markets. Sir, what is the outlook right now? What's happening in the markets?
Yeah, hi, good evening, Vishu. Yes, this is the third consecutive week. There is absolutely no clarity on the US-India bilateral trade deal. And whatever reactions you're seeing in the market is on the back of results. And IT results and Axis Bank results have been not really great from a market perspective. And in that process, Nifty has lost about 0.7 odd percent and ended below 25,000 kind of a levels. But broader market continues to sort of do well. It did outperform by gaining about 1%. We are clearly seeing defense back witnessing profit taking, IT is witnessing extended losses. I think real estate and some PSU banks overall are sort of doing well. Now, the challenge also is that in this upcoming week, you'll have a lot of Nifty company results. So you'll continue to see a lot of stock-specific reactions. And all these are heavyweights. We have results of Reliance, HDFC Bank over the weekend. Then you have Bajaj Finance, Infosys, DRL, Cipla, Tata Consumer, Nestle, Infosys. So a lot of results and which are expected to sort of shape up the overall market direction. But I think while markets have corrected, but we've seen only 3% kind of a correction. So it's not a major correction, I would say, and which is why I would still want to sort of stick out with 24,800 as the support level. And resistance would be placed at 1,000 points higher at 25,800. And we haven't seen markets correcting more than 3 odd percent since April. And which is why I think while nothing much is happening in the market, but I don't see a sign of a weakness also. Because when we look at the market breadth, now you have 65% of the stocks of the Nifty 500 universe, which are trading above their 200-day simple moving average. I mean, this was about 60 odd percent a week before, and in the last month, this was about 52 odd percent. So from that perspective, no inherent weakness in the market, but yes, no triggers as such, especially the US-India trade deal. And that will sort of continue to weigh on the market. We also need to see how some of these heavyweights come out with the results, because that will also sort of help. And I think dollar index, if it sort of subsumes or if it sort of resumes weakness, it could potentially lead to some better inflows from the FIs, so which again needs to be watched out for. So all in all, uncertainty still persists in the market, and which is why we are not seeing much of action in the market as of now.
Absolutely, sir. And there's a lot to discuss in the results as well, and I'll just get to that. But before we get to results, which is the main meat of the day, but can we talk a little bit about the monsoons? July is more than half done. What are we seeing about the rainfall?
So Vishu, for us, within the macroeconomic variables, crude oil and inflation are the two most important variables. And for inflation, monsoon becomes quite critical. So inflation last reading was about 2.1 odd percent, which is one of the lowest rates we have seen. On top of it, even the oil minister is talking of a potential cut in the petrol and diesel prices as well. But having said that, we'll come to monsoon. So monsoon, see, July month is the most critical month for monsoon. 1/3 of the rainfall typically happens. Overall, monsoon up till now has seen a cumulative rainfall of about 109% of the long period average, so which is above normal. For July, the forecast is about 106. So it is the overall rainfall is 106 only. So it's pretty unexpected lines. And I think overall sense is that monsoon up till now hasn't really disappointed. The spread of the monsoon has been good, except for some portions in South and East India. So that is where the monsoons have not been so great. But I think monsoons are very much required, especially for the rural economy. A lot of sectors, like, say, for example, FMCG, are dependent. On top of it, you have farm equipment segment, you have other consumer players in the durable side, which are also dependent. all in all, good news or the good monsoon run continues in an important month like July.
Absolutely. Let's get to the IT pack. We have the first few companies, HCLTech, LTIM, out with results already. What do you think about these?
So, Vishu, overall IT companies continue to sort of struggle with uncertainty. Most of the earning performance of IT companies is largely muted. Probably what slightly standout performance was from LTI Mindtree. Otherwise, the entire sector is sounding very cautious, and rightly so, because US has really not sort of done a lot of deals with most of the countries. Everything is work in progress up till now. So companies are clearly sort of highlighting that near-term growth and margin recovery is uneven and again dependent on client sentiment, and which again is dependent on how things sort of move forward. But coming to specific companies, LTI Mindtree, like I said, company came up with a steady performance. So this company gave a growth of about 0.8 odd percent, and there was a margin improvement. What we have seen of about 50 odd bips. Deal wins were also quite healthy. Third consecutive quarter, they've seen deal wins of in excess of $1.5 billion. So largely, despite the macro level caution, the company is relatively sort of more positive on that things will sort of look better from Q1 onwards. But the good news ends here. You look at HCLTech muted performance, 0.8% kind of a dollar revenue decline is what we have seen. Margins were under pressure. Deal wins again have been the lowest what we have seen in the last 2 years. And while they have sort of upped the guidance, say from 2 to 5%, that was the earlier guidance. Now this is the revised to about 3 to 5%. So the lower end of the guidance has been revised upwards. But I think they were targeting margins of 18 to 19 odd percent. That has been pruned down to 17, 18 odd percent. So again, that was sort of not really good from a market perspective. Wipro again, so revenue decline was about 2 odd percent in line with their earlier guidance, because they had earlier guided that the revenue will decline minus 3.5% to minus 1.5%. So that was within the stated guidance. The deal wins are also good, about 51 odd percent. But see, a lot of companies have seen good amount of deal wins. What we are still not sure of whether these deal wins are going to get converted into numbers, because even the clients are asking them to sort of take the execution of these deals in a slow manner. So that is sort of again impacting. And for a company like Wipro, next quarter guidance is minus 1% to plus 1%, so slightly better. So they're expecting gradual recovery. But then again, nothing out of the blue, which is going to sort of do very well for the IT pack overall. And even a small cap company like Newgen, numbers were quite weak. See, this company was supposed to grow in good double digits, but I think revenues got impacted. Revenues were up only 2 odd percent. EBITDA margins declined about 110 odd bips. Management is again expecting some recovery in the H2, but overall things are still weak. So in general, I think this mute expectations are still sort of sustained in IT as a pack, and which is why nothing much is happening. We are still not seeing positive trigger, and we have been highlighting also for quite some time that when we look at the Nifty earnings of say 12 to 14 odd percent over the next 2 years, it is very difficult for IET to sort of deliver that kind of a growth. And or even on the fact also that the dollar is not going to decline. My sense is that IT as a pack is going to struggle. So, in overall scheme of things, IT companies contribute nearly 11.5% from a Nifty weightage perspective. So that is not doing well for the Nifty, and I think which is why probably IT is going to witness more of a time consolidation. Probably price consolidation has already been done.
Absolutely. Moving on to Axis Bank, which saw quite a tumble today. It was over 5% down, if I'm correct. What happened with this result?
Oh yes, so 11.5% is contributed by IT and 37.5% is contributed by banks. And within banks, Axis Bank was the first bank number, and numbers issue were not good. For example, I think what we have seen in case of Axis Bank, there was a weak performance impacted by margin pressure, a sharp rise in the provision, and the business growth itself was subdued. Now, coming to individual parameters, advances growth was 8%, lower than the system level growth, what we have seen. So retail, they are slightly cautious on unsecured part. The deposit growth was okay at about 9 odd percent. On the margin side, we have seen at 25, about 17 bips, a kind of a margin decline quarter on quarter to 3.8 odd percent. And what the bank is saying is that since we have seen a rate cut of about 25 bips, which is why loan repricing contributed about 13 bips, and then there was some slippage in the agri side about 3 odd bips, and then they have done some technical reversals also, which contributed about 1 bips. And mind you, this is the impact of only 25 bips. So we have already seen a rate cut of nearly 100 odd bips, so 75 bips is still pending, and which is why the challenge for Axis Bank remains. So while the management is sounding positive on the future outlook side, so they're saying that in this entire through cycle of NIM, overall the NIM will be maintained at 3.8 odd percent because deposit repricing will happen. But slippages were clearly out of the blue. So slippages nearly double to 8,200 odd crores. I think companies, bank is saying that there's the internal policy change and they have looked at a recognition discipline in some of the categories like credit cards and overdrafts and all of it. So that triggered a good amount of technical slippage. And but I think what they are clearly saying is that going forward, they would deliver better than the industry level growth. And I think, but margins are again expected to be under pressure in Q2. So valuation, there was some headroom for Axis Bank to sort of do well, and which is why we have been liking Axis Bank. But I think for it to sort of catch up, I don't think it is going to happen in Q2 as well. So that way, I think weakness is going to persist in Axis Bank. But on the valuation side, yes, there is a comfort there.
Absolutely. Next up, we have HDFC AMC. What do you think about the results?
So pretty good set of numbers. No wonder the stock is at 52-week high. I think among non-lenders, I think AMCs are the best bet from a portfolio perspective. So HDFC Bank reported pretty healthy set of numbers. What it has sort of done is that when you look at overall, their AUM has grown at 7 odd percent quarter on quarter basis to about 8.3 lakh crore. Their market share is about 11.5%. And SIP run rate of 27,000 has been sort of maintained. So they're maintaining a strong market share of about 13 odd percent there. Revenue growth and pretty robust at 25%. And overall EBITDA growth has been about 30 odd percent, whereas profit growth is somewhere about 24, 25 odd percent. So that way they have done very well. I see AMCs as more of a structural play with superior operational parameters. And HDFC AMC is again benefited by multi-level distribution long-term performance. And I think I see this as a consumption play, and which is why I feel that the stock or the segment itself will continue to do well. We have increased our target price on this to about 6,500. So we continue to like this space from a portfolio perspective. With the non-lenders, I think AMCs are the best bet from a portfolio perspective.
Absolutely. I think hotel companies also came out with results. We had ITC Hotels, Indian Hotels Company coming up with results. What do you think about them?
So yes, within premium consumption, hotels continue to sort of do very well. There was some challenge because we had this India-Pakistan war in between, and that sort of impacted some growth or chipped off some growth in the month of May. But overall, coming to numbers, Indian hotels did about 32% kind of a top line growth. We had seen 14% kind of a growth in core hotels, and their air catering business also did very well. We are seeing double-digit growth in RevPAR, so that is continuing to do well both on the domestic side and also on the international side as well. Some dip in occupancies domestically again because of the geopolitical tensions. But margin-wise, stable margins at about 29 odd percent. So profit growth of eventually 28% and 27% on the bottom line. ITC also did quite well, 15-16% kind of a growth in top line. Indian business again, low teen kind of a growth, what we have seen. And RevPARs have also been good, 13 odd percent. We have seen good improvement in the occupancies as well. So this bank, even ITC hotels also did very well. Both the companies actually are maintaining good amount of premium compared to the industry level RevPAR. So Indian hotel RevPAR is nearly 60% higher, whereas ITC is about 34-35% higher. Now, coming to outlook, what is being clearly sort of highlighted is that next few years, the room demand is expected to grow in the range of 6 to 7 odd percent, and whereas the supply is going to be will grow at 3 odd percent, which means that your room rates are going to remain higher. Your occupancies might remain flattish or might marginally improve. But all in all, we are expecting good set of growth from this segment going forward. And which is why we are liking both these companies. In fact, the entire pack, we have a target of 950 on Indian hotels. We have increased the target prices of ITC to about 282. So I think hotel as a space is pretty much on the expected line, slightly better than the expectation, I would say.
Right, sir. And moving on, next up we have JSW Steel. What do you think about this result?
So when you look at the numbers, profit for this company has grown by 81 odd percent, looks very high, but from a number perspective, while revenue growth is down about 3 odd percent, volume is up 3%. Numbers are not so great, I would say, because compared to the expectation. Now there are some positives. The realizations have increased by 3,800 rupees per ton on expected lines. We are also hoping that the raw material prices will also come down, especially the coking coal prices. But as of now, we still don't see why the raw material prices has not come down. And as a result of that, the EBITDA per ton came out to about 10,600 odd per ton. We were actually hoping for 12,800, so lower than estimates. While numbers look good from a YY perspective, but it needs to be a lot more better. We're hoping that things will become better in Q2 onwards because domestic prices are at elevated levels, and some of the raw material prices also started to cool off. But yes, not a very great set of numbers, lower than anticipated, but we are hoping that things will keep getting better for steel as an entire pack.
Absolutely. Finally, sir, this is time for the hidden gem of the week. Which will it be this time?
So premium consumption is doing well. I already spoke about hotels. I think real estate is another segment which is doing very well, and which is why I'm recommending a company called Max States with a target price of 690. Now, this company is considered overall of. Can we do this again? मैं भूल गया.
Yeah, sure. मैं दोबारा पूछ लेता हूँ, sir. Right, and next up we have the final segment of the show, which is hidden gem of the week. Which will it be this time, sir?
So Vishu, premium consumption is doing very well. We have seen ample cases in the hospitality side. I think real estate is another leg which is sort of doing well, especially the premium leg. And with that in perspective, I would recommend Max States with a target price of 690. So this real estate company is considered to be the Oberoi of NCR region, and this is the real estate arm of Max Group. And what this company has is they've got a residential portfolio of about 11 million square feet with a gross development value of nearly 21,500 crores. And they have commercial assets also where the rental of 146 crore is what they get. Now, this company is guiding for about 12 to 15% kind of a growth over the next 3 years. So annualized pre-sales of nearly 7,500 to closer to 8,000 kind of a levels. For FY26 specifically, they are looking at between 6 to 6,500 crores kind of a pre-sales number. And so they're building up a good pipeline. So they have already sort of acquired about 14,000 odd crore worth of project, and about 7,000 odd crore worth of project is what they'll add in another 2 years. So that will give comfort on the residential side. On the commercial side, so they have got four properties worth about 1.3 million square feet, and where they're getting a rent of about 146 crores on an annual basis. What they're looking to add is nearly add four commercial properties at about 4.4 million square feet additional, which would take their peak rental potential to somewhere about 723 odd crores. So from 146 to 723 is what they are aiming for. So both the segments are expected to do very well for this company. And compared to a lot of players, this company is still trading at closer to NAVs, and which is why I feel that it's a value buy at current levels with a target price of 690.
Absolutely. Well, that was it for this time. Thank you so much, Pankaj sir, for your insights, and thank you so much, everyone, for watching. If you have any questions, please put them down in the comments, and we'll try to get back to you. Thanks again.
Thank you so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.